All right, guys, so now we're going to go ahead and take a look at Thinkorswim on TD Ameritrade. If you don't have an account, you can open one at tdameritrade.com. Now, TD Ameritrade will also be turning into Schwab, so you can open an account with either one of those. But actually, you'd want to do TD Ameritrade right now. But if you open a Schwab account, you'll be getting Thinkorswim over there in 2023. But for right now, go ahead to tdameritrade.com, download Thinkorswim to your computer. It's probably one of the best platforms for options trading, in my personal opinion. And I'm going to show you an example of a covered call, just like we were talking about in the last video. What we're going to do is pretend to buy 100 shares of Apple. So let's go ahead and click on the asking price here. And we have 100 shares as the default. That's one thing about Thinkorswim. It makes it super quick to place trades. It'll default to 100 shares. You can always increase or decrease that number to 200, 100. But for right now, for Apple, let's go ahead and put this buy order in. I'm not actually going to place this order, but I'll show you how it is placed. So essentially what you do here, I have it set as a limit order. I'm just going to do a market. So that's going to be sent through immediately, and that'll purchase 100 shares of Apple. And so let's go ahead and hit send. I'm not really going to hit send, but if I was going to, that's what would happen. And so buy Apple 100 to market to open. Let's assume we already own the shares in the portfolio. Now, once we own the shares in the portfolio, we're going to come over to the same tab here, the trade tab, and then Apple. Okay, so go ahead, you'll see the monitor tab. You don't need to worry about that. The second tab, though, is the trade tab. Apple, type that in, AAPL. Just as an example, or whatever stock you're looking at to sell a covered call against. Now, we just purchased these shares at $149.39, we'll say. So basically, we need to sell at a strike above that price. Now, I'm going to say that I'm pretty bearish on Apple. Okay, I want to say that with the market going down and everything happening, I believe Apple's going to go down. So I'm going to hedge my position here by selling to open a covered call. Now, since I already own the 100 shares, all I have to do is click on the bid price for this option, and you'll see that the strike is 150. So worst case, what happens here is I sell this option at the 150 strike, and I collect right now is $5.70 per contract. Now, since each options contract represents 100 shares of stock, what we're looking at is actually getting filled for $570 on that initial investment. So that's the amount of premium you would receive. Now, the max upside on this trade is 150. That is the downside. So if the S&P 500 and Apple stock go to the moon, I can't participate in any more upside up to the 570 level. I'm sorry, the 150 level and the $570 in premium. That's the max profit I can make on this trade. So what we would do here, though, as you'll see, it's just like a stock order. You're in a lot of ways, just like you were selling a stock. Now, it defaults to 10 contracts. We need to actually change this to 1. So I'm going to go ahead and go down to 1 contract since we're just selling 1 Apple covered call. And then what I'm going to do is you'll see the price is 570 limit. Now, typically, it's best to do limit orders for options, but you can also do a market order. Okay, so you can do either one of those, and you will get something for that. So what we're looking at here is, we're going to do a market order, just as an example. Or if you want to do the limit, you'll see the price, 570. And you want to go ahead and put in 570 for the limit. So we want to get $570 for this option. And so we're going to go ahead and sell 1 Apple 14th of October, 2022. So this is about a month out to expiration. So for being willing to sell Apple at 150, we're going to receive that $570 in premium. That's our max profit. Now, it says infinite on here as our max loss, but that's because we don't actually own the shares in the portfolio. So your max loss will be offset by the shares you own. Now, technically, the company can still go bankrupt. Okay, so that's another risk to consider. So if Apple were to go bankrupt, news came out, the stock sells off 100%, that's still technically your max loss because the shares would be worthless in that case, and the max premium you get is the 570. So that's just something to keep in mind. But essentially, the 570 plus the upside, if we're going to 150, that would be about what? We bought it 149.39, so we're talking 61 cents per share. But if you do the math on the actual percent that you're getting for selling this option, okay, if you're getting the $570, how much of the trade value is that? Well, we bought the shares at $149. We'll just say $14,950 was the trade amount. We're getting $570 for the option, and this is a month out to expiration. So what percent of the trade value is this? Let's do the math here, and I'll tell you exactly how much it is. We'll just say 14,000. Let's see here. Yeah, 950. So that's 3.8% of the trade. Okay, now, like I said, if I'm bearish on Apple, but I want to get long the stock, I can use this to hedge my position and generate cash flow for doing so. So that's just an example of how you can place these trades. Now, you can also do it through your regular broker. This is just an example through Thinkorswim. But nonetheless, we can take a look at another example. Let's go on over to Microsoft. This is, $242 per share right now. Let's look at about a month out to expiration. Now, the cool thing is you can actually sell these options a week out to expiration. Okay, you can sell them 2 weeks out to expiration. So if we're looking at the September 23rd options, these expire next week. That's my birthday, actually. So let's take a look here. If we're bearish on Microsoft, we want to get long the stock, we could sell this one right here, the 242.50 strike. Now, that's going to literally leave us no upside at all if we were to purchase these shares right now. We'd have like 3 cents upside, but the benefit of that is that we get $470 for purchasing those shares. Now, this one has a higher capital requirement. So do the math on this and tell me which one has the better percent payoff ratio. If you're buying 100 shares of this one, you have to spend $24,000 to get those 100 shares, and you're only getting $475 for the nearest dated strike. So take a look at Apple stock again, and you'll see that if you look at the strike prices here for the 150, okay, now that just went way down. I thought it was 570, but you get the idea, okay? So it was showing 570 before, but you're still getting the better payoff here. I don't know what's going on with the options prices unless my computer is just lagging and it's not keeping up with the options prices. That could very well be the case. Now, it says partially delayed data, but I've done some experiments with this account, and it should be showing real-time quotes. But nonetheless, you're getting the better payoff with Apple, technically. If you figure you're getting 570 at the 150 strike versus MasterCard. So that's something else to consider, is the amount of income you get. But also, you don't just want to purchase any stock, because just because a stock has high options premiums, there could be a reason for that. Perhaps the stock is more volatile. Perhaps there's upcoming news that's expected, and that's affecting the implied volatility, and that means the stock can be much more volatile. Okay, so if we look at this 570 strike here, it actually looks like we're getting, that's so weird how the options prices are coming up. But you get the idea, okay? So whatever the bid is of the option, you can basically sell to open. Now, if you want to buy back the option, all you have to do is do a buy to close order. So instead of actually exercising the option, what you can do is buy to close your position. Now, by buying to close your position, what you're doing is you're getting rid of it. At that point, if you own 100 shares of MasterCard, if you own 100 shares of Apple, what's happening is you can then sell those shares once the options contract is closed out. Now, like I said, you can wait till the expiration day as well. If you do that, though, if it's 1 cent in the money, let's say MasterCard, you'll see the 312.50 strike here. Let's say MasterCard is trading at 325 on the expiration day. So your option would be auto exercised. If you don't have the cash to actually, so essentially, like on expiration day, right, the 100 shares, they get called away. Okay, that's what happens. But in certain types of trades, you actually need to put up collateral, and so you have to keep that in mind, all right? Now, in this case, the collateral is your 100 shares, nothing happens. But like with certain types of put trades, or even other types of trades, like if you look at a cash secured put, you'd actually have to put up the cash and segregate all that cash to purchase those shares at the strike price. Now, if your option is auto exercise, that's going to be if you're buying the option. So, I mean, if you're looking at like if you bought a call option, and you have to have the cash to actually purchase those 100 shares if it gets auto exercised. So that's what I mean by that. But since you're the seller of the option, basically what you have to worry about is that you have the shares. If you don't have the shares, then you're screwed, because the stock goes to 325. Now you have a huge loss, and you actually have to go out and purchase those shares. So that's what I was trying to say. But if you're the buyer of the option, the best thing you can do is actually close out the position before expiration. Now, if you're the seller of the option, it works the exact opposite. Okay, so essentially you want the price to drop of the option. So since you sold the option to open, okay, you're short that option. So just like you would be short a stock, if you're looking at a stock that's trading at $50 per share and you want to bet on that stock price going down, well, guess what? You want that stock to drop down, to $1 per share, to zero. So you can buy back your shares. Obviously I'm being extreme there, but you want the stock price to drop as low as possible. Same thing if you're short the option, because what you can actually do is buy to close your position. So if I sell to open, what am I doing here? I'm buying to close. Now it just says buy in Thinkorswim, but a lot of brokers will actually show where it says buy to close your position. So since you're selling to open your position, you want to go ahead and buy to close the option. And you can do that if the price drops. We're getting 565 right now is what the quote says for this option. If you were to sell it, let's say, this stock keeps dropping, MasterCard keeps going down. What happens is it drops down to $300. Well, this option now is well out of the money. And so what happens in this situation is that, let's say the option price has dropped down to $2 per share. Now, why would the option price be dropping? Well, keep in mind, the expiration day is the most important thing to consider when it comes to trading options, okay? We have a September 23rd, 22 expiration day. What this means is, if MasterCard is not above the 312.50 strike and you sell this option by next week, okay, what will happen is MasterCard, this option will drop substantially because the time value is so little in that option. And so when you're looking at very low time value, that's a benefit for the option seller. It hurts the option buyer. And so that's called theta. And when you look at the Greeks of options, okay, what you can do is look at specific Greeks, and we can look at that in another video. But one thing that you'll see is theta, which is a negative number, and it shows how much it's dropping, all else held constant. If the stock remains the same and everything else, how much is the price of that option going down in value as we approach the expiration day? So that's theta, and that benefits you as an option seller. So if you sell this right now, and by next week, this stock is at 305, well, guess what? It's one of those things where you, as the option seller, can buy back that position, or you can just wait for it to expire, and then you'll collect 100% of the premium. Or you can wait for it to get extremely cheap, like down to, let's say, 10 cents, 20 cents. If this option is at $300, this stock is at $300 next week, this option will be pretty much worthless in that situation. So what happens is you buy it back super cheap and then roll it into another option, okay? So that's essentially how it works. And the closer you get to the expiration day, the more that call option will expire, like the faster it'll degrade in value. And so if you look at a stock that's and I keep on saying stock and getting those mixed up. But if you look at an option that's about a month out to expiration, like we could go to, let's say the 21st of October, right, and sell a monthly option, these are going to have much more time value, okay? And so we can see that it's going to be priced into the options. So you'll see that we can get $785 for being willing to put up. You'd have to put up $30,000 for this one, but you can get $785 as of the current quote. That time value is baked in there, and that will decline at a slower pace since it's out, a month out to expiration. But as you get closer, if you get into a week, a few days to expiration, that time value picks up dramatically relative to the price of the option and the percent that the option will decline before expiration. You're going to see that time value increase dramatically. And so that's what we're looking at here. Now, like I said, this is over a month out from expiration. So for a $30,000 capital commitment, if you're looking to sell the $300 put option, for example, we're talking about call options. We'll get into that next. But you could get $785. Now, if you were to sell this one, for example, let's say you buy this stock right now at 312 and you immediately sell the 3150 or 315 strike 1125 call option, you're going to get $1,125 for selling that call option. So this is a cash secured put trade, what I did over here. Like I said, we'll get into that in the next lesson. But as far as this goes, if you're looking to sell a call option, you could sell the near dated strike after you purchase those 100 shares if you're bearish on MasterCard, and you're going to get $1,125 or $1,125. That is your max profit up to that strike price once again, okay? And this says 10 contracts. So if you had 10 contracts, let's say you had 1,000 shares, that implies a $300,000 investment into MasterCard. You could generate $11,200 in premium just from selling this option. Pretty cool to think about. Okay, and so that's what you really want to consider when it comes to options trading and covered calls. All right, now when you're actually trading these on your broker, this is going to be a similar process. It's going to look different, but just keep in mind, you're selling to open, okay? You're selling the contracts. Now, if you had a $300,000 laying around, you could do 10 contracts. We're just going to say we have $30,000, and we're going to sell one contract at that strike. So we just bought our shares at 312. Our max upside is $3 profit per share. We have the 100 shares. And so this also will be factored in. The limit price of $11.20. You can also do a market order, like I was saying, but the limit order is going to, be much better when it comes to options because those options can have wide spreads. So that's the main thing to keep in mind. So a limit order at 11.20, we're hitting the bid. And if you were to do the reverse and you wanted to buy a call option, it would be the exact opposite. Just click on the asking price in Thinkorswim. But in this case, we're going to collect that max profit of just over $1,100 minus commissions, and that's going to be what we can generate for this trade. Okay, now this expires just over a month, and so you're looking at basically, it defaulted to 10 contracts again, but you get the idea. We'll go back down to 1 here. Whoops, we don't want to sell 20. Okay, maybe we do. I'll show you what happens with 25 contracts. So essentially, if you had like $1 million laying around, or not quite actually, it'd be more like $700,000. You could make $27,000 after commissions here, $27,986 for this trade here. Okay, so pretty cool to think about. You would need 2,500 MasterCard shares, but if you had that kind of money laying around, that's a pretty big profit just for being willing to sell your shares at the strike price. And one thing you can do also is look at, like, when you're going to do these types of trades. Check this out, right? So this would be finviz.com, one of my favorite websites for charting. And so when you're looking at stocks that, and the market in general, like where is this stock going? Where are some levels that have been tested? And we can look at the charts on Thinkorswim as well. I like to go to this website as kind of a backup. You'll see we're testing this level all the way down here. Now the market has been rough. So, you see that it's touched like the 305 level. This is for, MasterCard. At 305, roughly down to $300. It's touched this level like 4 times. Now, will it break this level and go under $300? That is a risk. But that's something else we can talk about in the next video, which is selling a cash secured put, which basically means you're committing capital to purchase MasterCard at this price, let's say $305 or $300. And so that's kind of what I was talking about, is selling those cash secured puts to get that passive income. And then if you get long the stock, if you end up, the stock goes under $300 per share, you get exercised, and then you can turn around and sell a covered call. That's called the wheel strategy. And we're going to get more into this as we go along. But the main thing to keep in mind is you can look at the chart and say to yourself, well, what's the likelihood of a bounce back here for MasterCard? We have the news coming out next week or very soon. Yeah, I think it's next week in terms of interest rates and how much we're going to get in terms of a hike. So 0.75 or 1% interest rates. Let's see what happens. But the market could sell off, and this could easily break $300 per share. But you could also sell at that support level, and then worst case, you end up getting MasterCard at a very key level of support. If it never sees $300 again in its lifetime, I'd be very surprised, personally. This is just a key level of support. It could become resistance if it breaks it, but nonetheless, you could sell a put option at that price and then turn around and sell a call option. That's called the wheel strategy. And like I said, we'll get more into that here as we go along. But the main thing I want you to take away from this is that this is actually a very simple process. It's easy as 1, 2, 3, ABC, right? So first, buy 100 shares of stock. Second, enter the covered call order. And a lot of brokers will actually allow you to put it all in at once. So it's called a buy right, where you actually purchase the shares and then sell the option at the same time and receive that net credit in return. I personally just like to do it differently. Like, I just like to purchase the shares and then do the covered call order afterwards. But step 3, collect the premium and then accept the outcome. So that's essentially the 3-step process. You first buy 100 shares. You then go ahead and sell a covered call at a strike that you are willing to part with your shares. And then whatever happens, if your shares get called away at the strike price, that's the agreement. That's what happens. That's your max profit. Accept it, and then you can always look for another stock to sell a covered call against to make additional passive income. So this is absolutely, the wheel strategy and everything that we're going to get more into is one of my favorite strategies, and it's one of the things that I really like to do when it comes to options trading. And really like practicing on my paper account. I'll show you guys that, and we'll get more into that as we go along. But essentially, this is a pretty simple process when it comes to covered calls. Now, the next thing we're going to get into here are called cash secured puts. Cash secured puts are going to be similar to selling options in terms of the format, but it's going to be different. Like I said, you're committing capital with cash secured puts. You're being willing to buy the stock at, let's say, a strike price. But let's go ahead and get into that in the next video. I have a PowerPoint we're going to go over, and then we're also going to go over specific examples of cash secured puts and how they can be used for passive income as well. So I'll see you guys in the next lesson.